All right, let's get right into it. In the first few months of 2026, the entire investment landscape for Southern Africa was, well, completely rewritten. A single geopolitical event forced every analyst, myself included, to basically throw out the old playbook and ask one really fundamental question. Where on earth do you find growth now? Back in March 2026, if you just glanced at the numbers, everything looked fine. Headline inflation came in at 3.1%. That's almost a perfect bullseye for the South African Reserve Bank's target. On paper, this number screams stability, control, like we'd finally won the long, hard fight against rising prices. But here's the thing. That number, it's basically a mirage. It's a lagging indicator, a snapshot of an economy that frankly doesn't exist anymore. It's a ghost from the past, and it's completely irrelevant to the new reality we're all facing today. That's because on February 28th, a conflict thousands of miles away triggered a massive energy shock that just changed everything. So the real question isn't about that old 3.1% number. The question for every single institutional investor right now is this. In a world with a brand new rulebook, how do you protect your portfolio and actually find some growth? So let's break it down. Okay, first, we have to really get our heads around the immediate damage right here at home. A word that feels so distant created an instant, very real economic crisis for South Africa. And the impact? It was felt almost overnight.
And wow, this just perfectly illustrates the scale of the problem. On April 1st, the price of diesel didn't just go up, it skyrocketed by over 7 rand per liter. Now, this wasn't just another fuel hike. This was the single biggest increase in the entire history of South Africa's inflation targeting regime. This one price change completely blew the whole disinflation story of early 2026 out of the water.
So, in response, the South African Reserve Bank is now gaming out two very different futures. In their best-case scenario, this whole thing is a short-term disruption, and inflation just nudges up to a peak of 4%. But in the prolonged conflict scenario, with oil staying over $100 a barrel, inflation blows right past 5%. That would force the SARB to fight this imported inflation with multiple, painful repo rate hikes, which would almost certainly tip the country into a recession. The stakes just could not be higher. And you know what? The bond market is already telling us which one of those scenarios it's betting on. We're seeing what's called a bear steepener. Now, all you really need to know is this. It's a signal of deep, deep anxiety. It means the market trusts the Reserve Bank to handle the short-term mess, but it is getting increasingly terrified about the country's long-term financial stability and its ability to pay its bills in this new high-cost world. So, with that pretty grim picture, where do you hide your money? The key is finding companies here at home that aren't just surviving this storm, but are actually genuinely built to thrive in it. Let's look at a couple of really key examples. First up, the most obvious safe haven, Sasol. Now, what's so fascinating about Sasol is that it functions as a perfect hedge. See, its unique technology produces fuel from coal and gas, which means its own costs don't really rise with the price of crude oil. So when global oil prices spike, Sasol's profit margin just explodes. It literally benefits from the very crisis that's hurting almost everyone else. And hey, you don't have to take my word for it. Just look at how the market is completely re-rating the company. In March, JP Morgan upgraded their price target from 94 Rand all the way up to 209 Rand. That's a 122% jump. This isn't just a stock going up. This is the market waking up to the fact that Sasol is basically a bet on how long this geopolitical conflict is going to last. All right, our second haven works on a completely different principle. Just sheer brute force defensive power. I'm talking about ShopRite, the country's low-cost retail giant. They've built a business model that actually thrives when consumers are feeling the squeeze. Their weapon isn't fancy tech, it's massive scale. And this is the whole game right here. While official food inflation was chugging along at 4.7%, ShopRite's internal selling price inflation was just 0.7%. This is their ultimate moat. They can absorb costs and use their incredible buying power to keep prices low for customers, which means they steal market share from pretty much everyone else. In this kind of environment, scale is your ultimate defense. But look, defensive plays and hedges aren't enough to build a whole portfolio. To find real, actual growth, we have to start balancing these domestic assets with opportunities outside our borders. Because let's be honest, relying solely on the South African economy is just not a viable strategy anymore. It's become a structural necessity to pivot to the broader region. The data tells a really clear story here. In less than a decade, South Africa's slice of the total SADC regional economy has dropped by nearly 5 percentage points. Power is shifting. Sure, South Africa is still the biggest player, but the direction of travel is undeniable. And capital, well, capital needs to follow that trend. And this is exactly why. Just look at the growth difference. South Africa is expected to grow at a pretty sluggish 0.6%. Meanwhile, you've got Tanzania clocking in at 5.5% and the DRC at a massive 6.1%. For us, looking at these numbers, the takeaway is crystal clear. The high growth opportunities, the ones driven by huge demographic shifts and new consumer markets, they're not in Johannesburg, they're in Dar es Salaam and Kinshasa. And companies that figured this out early are already reaping the rewards. Just take a look at Standard Bank. Their Africa Regions franchise now brings in a massive 40% of the group's total earnings. This is not some optional side business anymore. It's their main growth engine and a seriously powerful hedge against stagnation back home. Now, investing in this new world, it really requires a new way of thinking. You can't just look at PE ratios and balance sheets anymore. Some of the biggest risks and opportunities are actually hiding in non-financial data. We need a whole new risk matrix. So, there are 3 physical constraints that now dominate every single investment case. First, water scarcity. Water costs are rising at nearly 7%, and just securing a reliable water supply is now a major spending priority for companies. Second and third are all about logistics. Broken rail lines and clogged-up ports are literally putting a hard ceiling on our ability to export commodities, even when global prices are through the roof. These physical constraints have to be prioritized right alongside traditional financial data. For any resources company today, logistical reliability is just as important to its valuation as the price of gold. Okay, so let's pull all of this together. We've deconstructed the damage, we've identified the safe havens, and we've mapped out the new growth frontiers. Here is the actionable playbook for how to invest in this new reality. So this playbook gives us a really clear framework for finding resilient assets, even in a tough stagflationary environment. It's a 3-step process. First up, you secure your hedges. That means buying Sasol and gold miners as insurance against that war premium and all the global volatility. Second, you identify the tough domestic players like ShopRite, companies whose scale gives them that defensive moat. And third, and this is key, you begin a phased, systematic rotation into regional growth, upping your exposure to companies like Standard Bank that are plugging into those high-growth markets across the SADC region. Which brings us to our final thought. For decades, investing on the JSE was the default, the safe bet. But in a world that's now defined by these deep structural shocks, where the economic center of gravity is clearly shifting north, we have to ask ourselves a pretty tough question. Is the biggest risk no longer the volatility of new frontiers, but actually the stagnation of just staying home?